Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
Today, we are going to break down 4 more industry articles, but there's a couple of new things in here today, guys, that, well, a couple new, but one for sure is new. Right at the top, we have homeownership as the latest humble brag, but you may want to keep it to yourself. This is actually from Realtor.com, so this is like going to be interesting because there's some things that were said in here I'm like, I totally agree with, and there's some things I'm like, really? That's what you're going to say?
It happens.
Then we got an article from CNBC that is all about home equity loans. That's, of course, a hot topic right now because of how much national equity we have, as well as how many people we have talking to us about it, whether it's for debt consolidation, ADU builds, blah, blah. We also have what homeowners need to know as insurers leave high-risk climate areas. We did a whole show about this on Friends of Mortgage Heroes. We'll come back to this one. That's also from CNBC. And then we got loan performance insights from CoreLogic. This actually has to do with delinquencies and some very surprising data that will surprise you. Was that redundant? I think that was redundant.
You said the D word. You're probably so happy right now.
Department of data. Redundancy Department. So we're going to go right from the top, guys. This is going to be the first article. It is called Homeownership is the latest humble brag, but you may want to keep it to yourself from Realtor.com. Homeownership is becoming quite the status symbol, is what they're saying.
Yeah.
And the question that was posed here is, when did homeownership become a badge of affluence, and what does bragging about it achieve?
Yay! He owned something,
So
right?
what came to mind was, I wonder how holiday conversations go for those that bought, before 2021 and got a 2.5% rate, to those that, tried to buy last year that got squeezed out, to the ones that had to buy in 2022 when rates took a hike, and they're all over the spectrum, I bet.
You know what? You could brag about that because I did at the right time, right? Like, hey, I was a genius to take advantage of that opportunity.
So I think the way the question is even posed is obviously we know what the humble brag means. First of all, we know what a humble brag is. Like, hey, yeah, I bought a house. It's kind of a passing comment. I just did this thing that not a lot of people can do right now because of affordability and whatnot. So first of all, I would like to say that it is worth celebrating.
Of course.
I think there is so much stuff in our life right now these days where we could be dour, be down, have a depressed attitude about, or just be like sour over, and I think it's totally worth celebrating the milestone of homeownership.
I agree.
And if people are bent about that, I'm sorry. Look, I've been a renter and I've been a homeowner and I've been a renter again. We've been there, and so it is worth celebrating a life milestone. If you got a new job, would we be sitting around talking about, getting a new job is the latest humble brag? No, you got a new job or getting a raise or finding being in a new industry. We wouldn't sit around talking about this.
Well, no one's complaining when you're going over the housewarming party and you're enjoying the new space. So, I mean...
Now here's the thing, and I guess this is where I'm drawing the line. Like, I understand, like, stuffing it in someone's face like a nanny boo-boo, I can get a house and you can't. Like, that's like punching down, like crapping down the line, you know? But like that's not what this is really talking about. This is more of like as a social norm. Should you be talking about home ownership and achieving it? And some people are saying no.
So if you notice, anything that you do on social media, and not just home ownership, everything that you go out and do and experience is catered towards how can I showcase this in my social space so that I can let people know that I experienced this, I was here. Everybody wants some sort of social recognition. Yeah. And I think it falls along those lines. But the home ownership one, that's a huge milestone. That's like something that you work for, like, let's say 10 years. You say, hey, in 10 years, we're going to buy our first house. We're going to save up. No matter where you are in life, like that's a personal win between you and your partner, or you yourself that did that, that decision on your own. So whether you want to celebrate about it, I think it's your decision, and everybody else is just their opinion of whether they get to share it or not. I want to share it. I would share it. I'm happy. If my happiness bothers you, unfollow me. Don't talk to me.
Sorry.
I'm sorry.
Well, here's the other thing, right? This is the way I looked at it.
Yeah.
This is the way I looked at it. When I bought my first house was when I was renting, I would always think like, why do I want to do that to that house extra? Like, why do I want to put that floor in there? Why do I want to upgrade the kitchen? It's not mine. Right? But when I was looking into buying a home, how do I fit my family in there? 5 kids, right? You have so many of them. And then how do I tailor it to be what I want? Right? When you're doing your festivity holiday stuff, like Christmas comes, you want to decorate it like yours, and you want to spend that extra money to make it more fulfilling for your family, right?
Exactly, yeah.
And so for me, I think people who own a home, they can see themselves really enjoying it to that level, to that extent, versus when you're renting, it's very different. You still bring people in, but this is now where you celebrate your memories.
Well, it's like if you compare it with the renter than somebody else that bought a house, there's going to be 2 different points of view, like 2 different excitements. One's going to be like, oh, hey, happy for you, I'm still renting. Others like, you made the jump. I know what it is. I know what you're going through, those extra expenses, but they're all worth it down the line. Like, hey, 1 year in, you just got started. Hey, it's going to be okay on the other side.
And I think what you're describing is important for a lot of people because it's pride of ownership,
that's it.
not prideful ownership. And I think that's kind of what this is like, hey, these are people that are like, let's say, flaunting that they own a house. And, you know, some of the things you're talking about is that people putting like homeowner in their like dating profile. And I get it. Like, okay, that's fine. It's a sense of accomplishment. Again,
absolutely.
Like this is most people's largest purchase, largest monthly payment, largest tax deduction for the majority of people that are homeowners.
And we'll go to the benefits in that. You know,
well, yeah, we're going to talk about all this.
Yeah.
But so I don't necessarily think it's bad that people do that. I think honestly, this is a reflection of the sensitivity of people in social spaces.
Well,
I think that is exploding that in this article.
Exactly. And what I wanted to show with this is as of 2024, We're Atlas shows that 67.56% of our U.S. population are homeowners.
Yeah, that's the 2/3, more, just over 2/3.
You know, which
that's
is pretty crazy. The Midwest states actually have the highest.
Yeah, well, go figure.
Yeah.
Yeah.
So we're like West Virginia was the highest in the country at 74.6. I mean, I'd be bragging.
Yeah, that's awesome.
Right? Like, okay, I'm a homeowner. The majority of people do.
Yeah.
And then I was just curious. I'm in California. I want to see what that actual number looks like. So according to the Census Bureau of 2024, we're at 55.9%.
55, yeah. Mm-hmm.
Yeah.
Yep.
Obviously, because affordability, when you look at our, the medium price range of a home in California, it's high up there. It's in the 9s.
And I think part of it's
they're not stopping.
I think part of it's product availability as well. Like what kinds of shelter options are there? There's a lot of apartments in New York and in Miami and in Los Angeles.
Yeah.
And so I think the mix of product is part of that.
Yeah.
And as the affordability is as well. You also have California on the coast, some of the highest coastal property in all the United States. So there's that issue as well. And density of population. There's like, I don't know what the latest total population in California is, but it's like 13% of our entire national population is in California. So
I thought our numbers were going to be higher because almost everywhere I go and I talk to, it's like, oh, they own a home. So you kind of speculate that, right?
Yeah.
But until you see the actual data, it's pretty crazy.
I'm not actually surprised by it because there's a lot of pedestrian people in California. A lot of people come here and they don't root here. They just come here and then they leave here. Or they're from here and they leave somewhere else. So, I mean, we talk about this all the time when it comes to military. Not everyone that comes here gets PCS stays here or buys a house here. Now, they do end up buying homes with you guys, and those people root here or they keep this one when they go PCS somewhere else, but the majority of people don't.
Yeah, no, very true.
One of the things that I wanted to bring back from the article was homeownership as a status symbol. And I wanted to ask you guys, because they speak about the American dream. They say by the late 1940s, being able to purchase your own affordable, 1940s, exactly, right?
I want to ask you guys something about the 40s.
Yeah.
40 years before you were born.
Just so I can bring it back. By the late 1940s, being able to purchase your own affordable starter home was key to achieving American dream. So since the 1940s, I mean, we're all different age spectrums. So what does the whole American dream mean for you? What does the American dream mean for you? And I'll say what American dream means for me.
Well, you're talking about the generation that broadly was serving in World War II.
Exactly.
And then they came back and they was like, get an American job and buy a house. White picket fence, family of 4. That was kind of like the cookie cutter American solution. And homeownership was part of that. Obviously, so much stuff has changed economically. So much stuff has changed in global economics even. It's just too deep to get in all that. The point, though, is that was a way for people to achieve the American dream and own a piece of the land, own a piece of what it is you fought for and you stood by. And it broadly changed. A lot of variables changed,
and it's going to continue.
And it's going to continue that way. But I think that is when you look back, you're coming out of the Great Depression, out of the late the Depression of 1929, the Great Crash, and then you had the World War 1941 to 1940, whatever, 1944 or 45. I don't exactly remember the exact date. Sorry about that.
Versailles.
Fact check in the comments. But
I'm sure we will.
The end of the 40s was go buy a house. It was go buy a house and start a family and keep your job. Eventually, you're going to retire and get that golden watch at your 50-year anniversary of working, and you're going to off to the sunset.
Exactly. That was a blueprint, right?
Yep.
That's the blueprint that the traditions passed on to you. So I think those blueprints will continue to change. I think they've already drastically changed.
100%.
We're seeing now, I agree with Andy. I think that's the American dream. For me, it was the American dream to still own the property and hang my flag out there and be proud of what I have, right? And hire my gardener and all that good stuff that goes with it, right? So it's been great thus far, but there's the benefits still kind of have other layers.
No, 100%. I guess my argument is that I feel that the American dream isn't so tied down to buying a property anymore, and it's more geared towards, finding time, freedom, and being able to do whatever you want with whoever you
Yes.
want, wherever you want. Which real estate could still be a part of that plan.
Correct.
Yes, it's that you're not. It's that you don't have to occupy it. I think
Exactly.
the difference is it used to be I'm buying a house because I'm going to live in it. I'm going to raise my family in this and
Thank
keep it
you.
forever. Versus it's I own real estate still,
Yeah.
but it's an asset for me. It brings income to me. Your
Yeah.
generation is
Yeah.
looking towards that. Ours is as well, but as a let's say a mutation of how it started because we're kind of in this. We got 1 foot over here in the old way and another foot in the new way.
It's not old new. It's what it is, right? It is. It's a blueprint. Everybody has a different blueprint. They're going to look at it different, and social media is going to portray it differently. So I think a lot of people now are realizing before it was real estate, just you're going to work your 9 to 5. Right? You're going to have this information. You're just going to go back to work, back and forth. And I think the most people at that point in time, they didn't even identify what they love doing most.
No.
Because they were used to just kind of following the herd, right? Now with social media and all these trends, it has a different meaning to younger people like yourself that now I could see other opportunities with it. It's not just staying in that one. That one is, most of the people we talk to now, they're like, yeah, my American dream is to buy a home, but that's not my forever home.
No, yeah,
It's crazy.
I just spoke to clients today, and they own a house, and then they're like, "Hey, we want to buy another house." I'm like, "Well, what's the purpose? What's the goal? What's the reason why? If you already have a house, you say your payments low." They're like, "Well, we're looking at an investment down the line." I'm like, "Oh, okay, now that makes a lot more sense."
Yeah.
So, what are you guys looking for? They're like something that we can work in, build that equity. I don't need something like key turn ready, but what we want is our kids are older, they're gonna have families. So in the next 3-4 years, we want to position ourselves so that we're able to cater to the growing family, and then use that as a pedestal to then get to that big house where everybody could be part. I was like, oh my God, I really wish more people saw it like this. But then again, a lot of more people are.
Yes.
And it's conversations that are, arising more and more and more. And like you said, social media, double-edged sword, the way that you use it and look at it.
Yeah.
But at the same time, it does have, those outlets that allow you to say that there's more that you can do. And now with everything that's, information at the tips of your fingertips, you can really see if it's something that you want to go into.
I mean, it's
100%.
encouragement. Like, hey, he's doing it. Why can't I?
Yeah.
When we first got in the industry, 2005, Andy, what was the thing? You buy a house and you try to pay it off.
Yeah.
Yeah, totally.
We would do mortgage
Yes.
acceleration and teach people, okay,
Yep.
if you send a biweekly payment, you could take this down. You could take 4.5 years out of the life of the loan, right? If you put $200-$300 into it, you could actually pay it down and make it instead of a 30, because people used to see, well, 30, I'm going to 30 years to pay it off. Well, you could actually shorten the time if you do a biweekly payment and you add $200-$300. And there was a calculator we used for that, right?
I love which is still very smart.
Yeah, and so we teach them like you could take the position and create your own destiny depending on what your budget allows you to do.
And I think that's a big part as well. Like, going back to one of the guests that we had on Friends of Mortgage Heroes, he's like, when I got to the military and it got to, the point where I was getting out and they're going to tell us about, what to expect in the civilian life.
Yeah.
We talked about the VA loan. They said, hey, 1-800 VA loan, here you go, call it a day. So he's like, I don't blame them. He's like, but they only passed down what they knew, and they passed down. Their job wasn't to tell me how to build wealth and do this and do that.
Yeah.
But I think it goes, in everything. Our past generations didn't have access to this data, and now, times are changing, so we're all able to provide
Times are
that.
Yeah, I
changing.
think culture is changing some of that, and even here, and I think this proves kind of some of our point from the previous generation, but also what's changed is that people are looking for likeness. They're looking based on value, and one of the things here about whether people are putting it in their social profile or not, they're a homeowner, and when some people are saying, "Oh, that's braggy, that's off-putting," someone else saying like, "Hey, look, that might say as much about the values of the bragger as it does about the person who's looking for the person with a match of value." Oh, they appreciate homeownership. I do too. Maybe that's something we have in common.
Or
So it's not necessarily that it's a clash and it's like polar opposites, magnets pushing off each other. It might be that's the other way, which is that attracts me to that person.
Correct.
Because that is a shared value.
Yeah.
And that's about finding your person.
Yeah.
And I think there's, you're eventually going to have that conversation, whether they say it in their profile or not, and you find someone on a dating app and you're like, oh, okay, well, do you want to have dinner? And do you want to da-da-da-da? Like,
Yeah.
all right, or
you're going to talk about it at some point.
or there's somebody on those dating apps looking at this like, time investment, money investment.
Yeah.
I could just go and be with someone that owns a house and hey, there's my rent and mortgage.
It could be like that. It could be like that. Many ways of looking at it. I don't mind it. It's all good. Do it.
Yeah.
As long as you're buying a house, it doesn't matter how you get on there. You get slapped onto the title.
So
All right.
here's what I want to do, guys. Is it okay if I throw this out here?
Yes,
Absolutely.
Survey.
yes.
It's a survey of people that see this segment. I want you to put in the comments whether you think homeownership is braggy or should be celebrated as an
that's
achievement.
a good one.
Is it if you communicate that online or you put it in your social profile or your dating app? Do you think that this article that is saying homeownership is the latest humble brag, but you may want to keep it to yourself? Should people share it or keep it to themselves? Share that you're a homeowner or keep it to yourself? That's what I want to know in the comments. What are we going to say?
What I was going to actually say is I wanted to test you guys. Which state do you guys think is the least, has the least amount of homeowners?
The
Hawaii.
state?
What state?
Hawaii.
Hawaii.
Alaska?
Alaska. Oh, wow. That was good. You guys were all far off. New York.
Oh, New York.
I'm so, you freaking
New
told me
York.
earlier when you were
Yeah,
telling me, giving
I
me
did.
notes.
New York was at 54.4%, and we're at 55.9. We're
right
not
there.
so far off, guys.
I went with Hawaii because of affordability.
Yeah. But
I went with Alaska because who the heck wants to live in Alaska?
you got to remember, a lot of the people in Hawaii, the natives actually stay there.
Yeah, that's
Yeah,
that's
makes
yeah,
sense.
it's passed down. You know,
You know what I mean? So it's very, very different.
Same
But
with
yeah, I
Alaskans.
wanted to share that information because I
Great
thought it was
question.
pretty cool. You know what I mean?
That's awesome. Great
So,
question.
You got us.
Well,
Yeah. Finally.
I'm very eager to see what these comments are about that article.
Me
guys.
too. Yes.
Let's move on. We're going to talk about the home equity loan. This is a little bit more detail oriented today, guys. We're going to talk about home equity loans for those of you who are homeowners already, and you may have heard what a home equity line of credit is, or the acronym HELOC, home equity loan, home equity line of credit. This is from CNBC. Now, this is a little bit more of an evergreen piece from CNBC, kind of talk about the generalities of HELOC. So I want to go over some of these things, but I also want you guys to say from the front lines, how do you see people using this? What are they doing in San Diego? What kind of scenarios should people watching this go, oh, that's me. I heard my scenario in what they just said.
We were talking about earlier about the 40s, how everybody's blueprints change. I like to use blueprint only because, you know, my mom taught me a certain blueprint of what I needed to do, how I do debt. My mom told me, don't get in debt. If you can't afford it, don't buy it, right? And then as you start seeing, studying more rich people, they understand how to generate proper debt, right? There's such a thing as good debt, you know? And so those are the things that my main focus is on now. So my blueprint's changing. I'm hoping to change that blueprint for my kids so they have this different, view of things and just want to take a little more risk if they need to. But anyway, when we were doing home equity lines of credit back in the day, and you remember this, these lines of credit were not being utilized in the way they were meant to be utilized. Right? We were using them to keep up with the Joneses. If he has that Hummer, how do I get that thing too?
Yeah,
right?
It was the Hummer equity line of credit.
Very,
HELOC.
very. Exactly. I did it in a reverse way. I was acquiring more properties with it. Hey, I didn't have to put 100%, and then you get to a point where 100% doesn't work for you. You have to put money down.
Yeah.
And so at that point in time, that's when I started buying more with using the line of credit here, buying that property.
Yeah.
So it just depends how you utilize it. But back in that time, Brian, that's how it was for most. How do we purchase things and just spend it on things that create no value for you?
Wants
They just become
versus needs.
There you go. Exactly. So nowadays, I think with all the information with social media, they're getting very creative in a sense. Let me teach you how you can utilize this so you can generate more wealth and create another financial vehicle to help support your financial income, whether it's creating an ADU, investing in other properties, and investing in another business. These things are happening.
Yeah. And I mean, there's still a lot of that going on probably, like not say, but a lot of the financial habits have changed. And I feel like some of the clients that I'm speaking to right now, last year when they pulled the HELOC, they weren't in so much debt, but they're like, these credit cards are rising and, a whole bunch of and interest. But my mortgages stayed the same. How can I utilize that, have a clean slate, remove money over here and put it back over here? So, I think a leverage point is utilizing it to wipe out your debt, but at the same time using it as a pedestal to go, jump onto something else. Now, one of the things that I think people need to understand is, the product and how it works, and also their situation, because, taking that money sometimes isn't always the best route, because then how are you going to pay it back if you don't have an exit strategy? So I think really identifying, your situation and knowing if you can pay it back down the line, whether it's, through adding value to the property or, you're going to consolidate your debt and it makes financial sense. I think that's the smartest way to use it, but not, if you just if you have the money, don't
Yeah.
get it more money if you don't need it.
Yeah.
Yeah. So the first thing I think to know here is that, you know, when you're looking at home equity line of credit, you are tapping into your home's equity. Okay.
Correct.
It's in the name. It's home equity line of credit. So this is something that you have to be wise to consider to make sure that you are putting yourself in a position that is advantageous versus at a further disadvantage just because you qualify to do it. So there should be a plan going into it and a plan to get out of it, or a plan to be smart and wise about how to use the funds either upfront or along the way or over the course of time. There are situations I've heard you guys talk about and people talked about me in the past about, which is they wanted it for a rainy day. Now, that is also okay. However, if you do pull a rainy day home equity line of credit and you do not use it, the bank can also pull that back and they can reduce the total limit or just ask to close it out because you're not using it. Now, that is maybe less rare than normal, but I just want everyone to know that that is a possibility as well. If you take one out for a rainy day and you don't use it, well, if you don't use it, you lose it in some cases. But if you're going to use it, it could be for a lot of different reasons, guys. We see debt consolidation. We see people doing it can do a garage conversion, to have a rental unit on their property, to build an ADU, add a second story, extend a wall. Like, there's all sorts of home things that the house can do the heavy lifting for.
So use it before you lose it, but don't abuse it.
Okay.
I like that.
Brian's rap channel coming March 2024.
Yeah. Well, here's the
One
thing.
song.
Here's the other thing to remember. There's two types of equity lines of credit. There's a HELOC, home equity line of credit, and a HE loan. It's just a home equity loan. The home equity loan, the way it is once you take that money out, your property has to have X amount of value, right? So let's just say $100,000, just to keep it simple. And you owe right now, hey, the value of the home is $100,000. You owe $50,000. You could go up to 80%, sometimes 85, 90% loan to value, depending on your income, you know, and your pretty much what your income is, what assets you have, et cetera, where the bank's going to take more of a heavier risk, then they'll let you borrow more from it. But let's just say you get to 85%, you know, loan to value. Those funds immediately on a HE loan, they'll deposit them to your account.
Yeah.
So you start making payments the following month.
Yeah.
You know?
Yeah. It's already.
Exactly. It's already there. Whereas a HELOC, the home equity line of credit, works more like a credit card.
Yeah.
Yeah.
You know, you have it there, and that's the one that you can use for a rainy day.
Yeah.
But usually that comes at a higher rate.
Yeah.
You know,
Yep.
you just got to see what line of credit is going to fit best for you.
Yeah.
100%.
The thing that I want to make sure we also talk about is that, you know, the article references that people sometimes use it for repairs or renovations or maybe even upgrades, and that in some cases that can positively affect your equity. But I want to caution everybody, just because the article says that, you have to take into consideration some other things. So listen up. Number one, just because you change your faucets from old to new doesn't make your house worth $100,000 more. Number one. Item number two, just because you change your flooring does not mean that your house is $100,000 worth more. Not everything on HGTV is as it seems. So the truth is that if you add square footage, if you're adding to the footprint of your property, and it can be compared to other like-sized properties with the same amenities, you stand a far better chance of that increase of equity. So be careful. Just because you build a $50,000 pool in the back, the bill's gonna be $50,000 to build a pool. That doesn't mean your property's going up $50,000 right away. So be very careful with that, because a lot of these articles I've seen, including this one, you know, say that, oh, this is a way you can increase how much your property's worth. But that has a lot to do with if you add on, not just make it modernized and updated.
I mean, that's a great point. It really is. You're not going to get dollar for dollar, right?
Nope.
If you have that $50,000, $100,000 pool, I've seen a $100,000 pool just get, when they do an appraisal, $25,000.
25, 30.
30,000.
Yeah.
But wait a minute, I spent 150,000, right? It's like,
good for you.
Yeah. Or they buy this brand new house in this lot, right? And it's got X amount of views, so they send it with a higher premium.
Right.
You know, and the new bill, usually 40, 50,000, but when the appraisal, it's a $10,000 view.
Yeah.
So it's crazy. So yeah, it's not dollar for dollar. So
Yeah, I
that's
think
a
you
great
got to
point.
look at price per square foot. You got to see what is it you're looking to change, and then is there an equivalent value increase based on the comparables, like what you will have at the finish of your upgrades or modernization or whatever it might be. Modernization in some cases brings it to what the value should be, not what it's going to be.
That's what I was going to say, because what if there's a block where, you know, houses are for the most part all got flipped and they look nice, and then somebody decides to, you know, join the crew, and then heck yeah. you're just going right at market, buddy.
I mean, sometimes it's good to just bring it up a little bit.
Yeah.
A little facelift. Not bad just to sell the property much faster.
Well,
you know?
sure.
And those things do.
Because here's the other side of it. You put your house on the market now and it's 30 years out of date. Someone's going to give you a 30 years out of date price. They're going to go, hey, give me a 10% off on that deal or 15. I'm not going to pay you full price on that.
And
deal.
I don't know, Andy. You're in California.
No, hold on. I know here.
I know, it's
That's what
crazy.
we're talking about because someone will still buy that at market value or outbid the next guy and do the upgrades on their own. My point is, though, when the article is saying use a home equity line of credit to tap into your equity, do upgrades, and then that's going to make your house worth more, that's not always the case.
Correct.
There's some definite things you need
not
to
going to be
more
dollar for dollar.
considerate
That's for sure.
Yeah, so
that's a great point.
If you are going to get a home equity line of credit, you need to make sure you have sufficient home equity. You need to make sure your credit is in line. You have to have proof of income. You have to have a low debt income ratio.
Yeah.
There's got to be, insurance. Like there's a lot of things that are technical, but they can be easily overcome by just having a little of a checklist, a conversation with one of the guys, and then figure out what you got to do.
And
Go ahead. Here's another misconception on the lines of credit, right? When you do a mortgage, when you're getting a purchase or refinance to do your major mortgage, you got to do your pay stubs, your W-2s, all that stuff. But people think when you do a home equity line of credit, I don't need to do those things.
Yeah.
No, same sequence. It's the same information that's going to need it. Why? Because in lending, we need to support that you're able and capable of making those payments.
Yeah, the full payment.
That's the exit strategy, that you currently have a job, that you currently have the income, that you're able to make these payments for your first mortgage.
Yep.
And the second.
Right.
And the additional money you're asking for. Yeah.
That's it.
What I was going to say is that last year, on the flip side, we had a client that didn't get approved for a home equity line of credit, and it was because she had a lot of high credit card debt, pushing the 50% limit. And one of the things that, I'll let people know is that, don't wait till you're at that point. If you're able to seek help or seek that solution before you get into that problem, definitely, search sooner, because once you're down that road and you're too far in, it's going to be very difficult. And for this case, our client wasn't able to get approved because she was already maxed out. And the bank knows at that moment you're utilizing that to basically bring that down.
Yeah.
And that to them looks like a risk.
So I want everyone that's watching this to know, like when you come and talk to Brian, talk to Memo about this, they're not hard pressed to sell you a loan, guys. It's about figuring out what is you're trying to accomplish, and is that even the best way to do it?
Yeah.
Sometimes that's not even the best way to do it, and sometimes there's no other way to do it, and the house has to pull some of its own weight, and you're going to have to use that equity. But that's what these guys are for, and that's what they'll help you.
Just like anything else in life, there's pros and cons.
Yeah.
Yep.
100%.
And the only way to get out of something is you got to take the leap of faith and risk.
Yeah.
Sacrifices.
Yep.
That's right.
So, guys, we have to talk about insurers leaving many states for multiple reasons. Let's put it that way. Insurers such as State Farm and Allstate are leaving fire and flood-prone areas, and home values could take a hit. I understand the argument, but let's get into that a little bit. This is from CNBC. We've already talked about this in Friends of Mortgage Heroes episode 3. Quick shout out to our other playlist on our channel. Friends of Mortgage Heroes is where we talk and interview people in and around real estate that we know, love, and trust. And we talk to them about their experience, their industry, and what knowledge they could share, help you all learn something about what they do, but how that adds value to your life as a homeowner or aspiring homeowner. So check out Friends of Mortgage Heroes number 3 with Carlo Diaz with Old Harbor Insurance. We talked about this exact problem. Insurers leaving California, the California Fair Plan stepping in and replacing most of these people, but only with fire coverage. So here's the deal. State Farm stopped accepting new applications. Allstate announced that they are going to pause new homeowners. They're not doing renewals for people in California. And, I don't know exactly when they're going to come back. I have a suspicion, which I'll share in a minute. But here's the bottom line, is that the risk is really high actuarially for these businesses. And as that risk increases, so does the cost of insuring the assets that people have on hand, which is their home.
No, it's crazy. This insurance situation is crazy. I'm getting calls from our clients like, hey, they just dropped me. What do I do?
Yeah.
Right.
Who do I go to?
Right.
And it's a panic mode because, you gotta insure one of your biggest assets.
Yeah.
Well, most people aren't sitting on the cash to do the replacement cost of $300,000, $400,000.
Exactly.
That's what the insurance is for.
Yeah. But it's getting too expensive for also insurance companies, right? With everything that's going on, flooding. And you guys see on our social media, San Diego, it rained over here, but they're making it seem like Barrio Logan is underwater right now. But it wasn't. It isn't. So a lot of times it's just,
Well, it's temporarily.
I don't know who's throwing these social media videos, right? Is it the insurance companies
Dago
to make
TV?
them think? Who is it?
Dago TV?
Well, I did a little bit of research about that in preparation for today because we did just see that here in San Diego.
Yes.
We did see that the industry is going to have some severe consequences and possibly even the city because of flooding in San Diego that has actually caused loss to residences and to businesses. I have a personal friend who lost a substantial amount of equipment, assets, and vehicles in the flood because it was connected to a city pump that was not turned on. I'm not going to say anything else about that because I'm not going to get into the scuffle between the city and people, but I'm just saying for some people that happened.
It did. It did. And it wasn't like 5 feet of water. It was like 2-3 feet.
Yeah.
You know what I mean?
Well, still, yeah.
I know what it is.
I saw houses underwater, like the roof. Yeah, I'm telling you, the roof is like the only thing you see is the roof.
That's
like,
Louisiana, probably, right?
No, this was Spring Valley.
I know. It's so you have an understanding. Spring Valley is a higher elevation.
Yeah. So the deal is here, guys, that insurance carriers cannot get the premiums increased as fast as possible in California because of a rule that does not allow them to increase their rate of insurance premiums by more than 7% without approval by the insurance commissioner. And going back from what Carlo was telling us in episode 3 of Friends of Mortgage Heroes, he was talking about how that you have to apply for that like every 6 months. You can't do it more frequently than every 6 months. Yeah. So it's like I'm gonna ask for a 7% increase right now, and then in 6 months and 1 day, I already have my next increase request up, and it's because the replacement costs have soared so much, it's well beyond the 7%. Yeah. So even if they get their 7% approved right now,
not enough,
and then another 7% approved in let's say like June or July of this summer, they're still behind the 30% increase of some replacement costs for goods that go to rebuild homes.
I mean, this is a true story. I had a client this weekend. She's actually close family. Sends me an email. Why does my payment go up so high? And I said, I thought I had a 30-year fix. And I'm like, you do. I go, what you have to do is you have to reach out to your insurance company because I think what happens since your property is escrowed, they're taking your property tax and your homeowner's insurance. And I know property taxes increase, but they don't increase, in the hundreds of dollars a year. They're maybe $100, $200, if that, for the year. So I said, check your homeowner's insurance. Sure enough, she went, and what happened is she was used to paying $850. Now she's paying $4,400 a year.
What? Wait.
The premium
went from $850 to $4,400.
$4,400. So if you do that, you're good at math. What does that average out for?
That's
monthly?
like another $275 extra.
So when they're saying
$3,200, no, what is it? $3,600 difference? $3,600 approximately. That's $300 a month more.
So if to add to perspective in this, yes, it could affect a home purchase too, right? When your payment now is going to be way higher than you thought it would be, only for I remember we used to calculate $85, $115 a month, right, Brian?
Right.
More or less.
Yeah,
now,
65, 75 on the high end.
Dang.
Now I start off at 100.
Correct. So it's things like this that are actually also
but that screws with DTI.
Exactly.
That screws with the debt to income ratio.
And that affects affordability.
Yeah. Even at the end, if it's literally $10 above your debt to income ratio, I'm sorry that loan's not going through.
Exactly.
Yeah,
so it's so silly, but that's how it is.
We find ourselves in
Make
this
or
like
break
damned
it.
if you do, damned if you don't.
Correct.
Because you can't get a mortgage without insurance, and you can't get insurance if the carrier's not here. But then you can't. The mortgage company can't loan the money to get their interest they want unless they can get a buyer who can qualify. Like it's like
now
it's like a circular shooting.
Correct.
But now when you did find the insurance is too expensive, and now you can't do the loan. So therefore, you can't buy the house.
What's interesting?
Well, what are you guys doing now then? What's the solution?
Carlo.
Okay, I know that.
Andy, so luckily we are not in the insurance business. We're in the lending business. So thankfully, I have great partners at Old Harbor that take care of it.
Most of our clients, obviously, they're military. They go to USAA.
Really
They go to Carlo, and we also got Kim with Driver's Choice. She's been phenomenal for many years. But again, I mean, with this article sharing here, I mean, we have these people in Sonora, California. They were paying $2,000 and they got dropped.
Yes.
And now it's going to an annual fee of $12,000.
Yeah.
I mean, these people, they lived there for years. They gotta. Now they're saying like
we can't afford this. Yeah, I might have to sell my house because of this. So
interestingly, that you brought that up. What I read also that increase in insurance actually hurts them down the line if they want to sell, dropping their purchase. I mean, the value of the house 12%. So now on top of you not being able to find insurance, and then you're gonna have to, I guess, sell the property. Yeah. Now it's gonna ding you for not being able to find insurance for the next people that come in and try to take the property.
But, and part of this might just be temporary, and this is a long shot. But I'm remembering the conversation about asking Carlo. I asked him like, when are the carriers going to come back? Like you're going to have to re-entice these massive companies to come back. Now, hold on, before I continue that thought. I want to address this. I understand in some of our shorts from that episode and in our comments of that video, insurance companies have still raked in billions of dollars profit.
Of course.
I absolutely understand that. They have to in order to continue providing insurance. So is the argument about premiums completely valid and that it sucks? Yes. Is it also true that they're making money? Yes. Do we need them to make money so that they can continue offering the service? Yes. You can choose to go without insurance, except there's consequences in the state you're in for whether you drive. For your car, but also for your home. If you're gonna have a mortgage, you have to have insurance, and you risk not being able to rebuild your house in the event of a catastrophic loss. So it's like you have to. What I'm trying to say, it's like we kind of have to live with that, and then just make the best choices possible.
Yeah, you bring in a great point, and this is from the company that stated. Even though there wasn't an increase in major disasters in 2023, he said the industry is still expecting to see a $50 billion in loss just because of severe consecutive issues such as flash floods and implications of heavier everyday storms.
Yep.
Well, just
That's what we had here.
That. So I know
That's
it sounds
exactly
like we have
what happened here.
Just in California, I remember to begin 2023, I was driving through Northern California, and there was a freaking storm everywhere. All mid-California was flooded. The freeways were closed down, and that was last year. So you're telling me this year we started off the same thing. So, yeah, a lot of these houses were already dealing with stuff from,
And not only that, so we have damages to properties. The other thing is most of these insurance companies also provide auto insurance.
Yeah, right.
And so you already know us Californians, guys. We see a drop of freaking rain, and all of a sudden, we go from 75, 65 to down 35 miles an hour.
Oh, I thought you say go from 75 to 100.
No.
I go the other way.
We're not used to the climate here, so raining, right? Like we can.
Some people don't even show up to work. It's like a national holiday. Like no more.
We don't need a weather forecaster in San Diego, right? Like we already know what the weather's going to be down.
It's raining.
3 months.
Everybody stay home.
Yeah, exactly.
Work from home.
Crazy. This is unresolved, guys. There are some things that legislatively have already changed or are going to change in 2024, but don't take effect until 2025. So. We're at the beginning of the year still, guys. We have 8 more months still to go for 2024. And then in 2025, some of the things that are approved now will start to take effect and be impacting homeowners. But until then, we just got to kind of like ride this crazy storm and deal with it and get connected with people that we know and trust and who can provide policies.
That's it.
Because we're really going to be left with who's left.
Yeah.
I know that's like such a dumb saying because you're always left with who's left. But look, when you got State Farm leaving, you got Allstate leaving. I know I've heard Farmer's name and they're not doing some renewals. Like, other friends of ours that have other agencies. Like
Geico took other operations from California.
I know.
Done.
So earlier you asked, you're saying, so what are they doing to, the people that they can't insure? What I have noticed compared to previous years when things were a lot easier is that they have a lot more stricter underwriting guidelines when you send the house. So now they're asking, when did the roof get last replaced? What's the condition of this? How many people are going to be living in there? Like all these little external things that never got asked before. It was just say, here's the property profile. Great, perfect, looks good. Awesome.
Yeah.
Here's your policy. Now it's like, oh, it's going to take 2 weeks because we have to take it through underwriting.
No, it's a 30-day underwrite.
Oh, yeah, there you go.
30-day.
So there you go. Up to 30 days on something. And we're over here trying to close in 14 days.
Wait,
in
it's taking 30
it's a 30
days
days.
for some right
There's an
now?
article. Yeah.
No,
Yes.
I know, but I'm saying front
30
of,
day.
I'm saying front of lines. You guys have 30-day responses?
Not 30
No,
days.
no.
But they can take up to.
It could take up to 30 days. And here's the other thing. You can get insurance right now, but once they go into Google Earth and they do their underview, they can cut you off after that.
Like,
So
there was
these
some-
are things that happen.
I had one that we sent it out, and then once we got into escrow, they literally, hey, this has to go back into underwriting, and came back a few bucks higher, but still, it got rechecked.
Yeah, I remember we used to get same-day declaration pages?
Yeah. But the thing is, it just depends on the area, Andy, is what it is.
Super high.
Yeah.
It depends on the area. The good thing is we're mainly here in the suburb. We're good.
Yeah.
Right.
But if they're going to Hamul or something like that, where
Well, there's not even coverage in some of those areas.
Exactly.
You're only going to
You
have
have
the
to go to the
California fair.
One
California.
thing I did run into last year with one of the sellers that was proactive, they actually pulled an insurance report and gave the area a breakdown of what type of zoning it fell under, so that when we went to go apply for our insurance, they gave us that. We were able to send it to them. They're
That's
like,
smart.
oh, cool, this was really good. And it was actually through Allstate that we got that insurance policy.
Gotcha.
Or I don't know if it was Allstate, but that was one of the ones that they provided
Yeah.
from. Yeah.
Okay, so for our clients who are watching this and they need help with their insurance, they can call you guys and we can get them to somebody.
Yeah, absolutely.
Yeah,
And then
absolutely.
for our agent partners who are watching this, I like that idea. I didn't hear about that idea until right now. That they are actually, you're saying the listing agent is supplying the
Yes.
buyers with insurance options so that they
not
can get,
insurance options, but with a detailed
okay, got
breakdown
it.
of what zoning, whether it's flood, high fire area, but it
Okay.
has all those information so that when an insurance provider sees it, they're like, I know exactly, and it's very recent, so they know it's very recent data. Sometimes they go based off other stuff. This is so that they know exactly.
We were talking earlier how the blueprints, everything's changing. Everything's
this is
changing. Even our roles as loan officers, realtors, you're saying that like all our roles are changing.
Yeah.
There's more
Yeah.
that needs to be added into this.
Yeah.
We're no longer that traditional type of lender. So, you want to have, if you're working and purchasing a home with the realtor, with the lender, make sure that they're in tune with happening in the community.
Yeah,
Yeah,
100%.
you
You know,
have
a lot
to.
of times,
Yeah.
I'm going to go through the XYZ, but they're in New York and I get that the rate, everything's good, but having that proper support, being
Hyperlocal.
of exactly.
Hyper-local.
Yeah,
Hyper local. That's it's just gonna help you in many
Yeah,
ways.
yeah.
Oh man. Well, if you guys
This is tough.
if you're watching this and you need help with your insurance and you're in California and you're in San Diego specifically, we can help you. we
Yeah.
can help you out.
No,
Also,
and-
if you have solutions and you are an insurance person watching
Yeah.
this, comment below. Tell us
Please.
what we might not know. Clarify some things that you heard during this segment, and let us know how we can help more people understand what's going on.
Also, shameless plug, Carlo actually just dropped a really good informational video. If your policy has been going up and you don't have any tickets, you don't have any inquiries, definitely reach out because there might be something you're able to do about that.
Correct.
Oh, okay.
Yeah, so-
Yeah. Good.
Yeah, no,
Great
and
point.
again, big shout out to Carlo,
Yeah.
USAA, and Kim. I mean, they've been
And
phenomenal.
no shameless plug. Like, these is just ways to save. Like,
That's
anybody
it.
could help out right now. Anything, like, even if it's a couple bucks, like, just, do your financial
Yeah,
research.
no, it's
Like,
it's incredible that they're still fighting, and it's tough
Yeah,
out there with
they're
that
gonna
when it
have
comes
to.
to insurance.
I feel like getting savings is one layer. Getting insurance,
Getting
period,
insurance is the
another
biggest
one.
thing. Correct. Yeah, again, you're protecting your investment.
Yeah.
I have a client right now that I'm helping has no homeowner's insurance on his current property that is free and clear.
What?
And I'm
Wait,
like,
for real?
please, like you need to protect your assets, literally.
Oh man.
I know it happens.
That just like automatically, I was like, oh god, that
Yep.
makes me very nervous. Okay, let's go to Loan Performance Insights, guys. This is from one of my favorite places because I'm a big old dork. This is from CoreLogic. This is about loan performance insights that talk about delinquency. I was very, very surprised about this. Well, I'm sorry. I was actually two sides of the same coin. Very surprised on one hand and not surprised at all on the other because the data tells you exactly why. So they measure early stage, mid stage, and late stage delinquencies. It's obviously important for measuring the health of the mortgage market. And what we see here is that from November of 22 to November of 23, there was zero change in delinquency rate. So I'm right away going to remind everybody it's because they got those golden handcuffs and they got these super low fixed loans in 2020 and 2021 and 2022 in the beginning. And delinquency rates did not change despite economic
crazy.
factors, affordability, jobs, and other stuff, and inflation. Delinquencies are the same.
That's crazy.
Hey, but drop in the comments. It's crashing. Let me know. Let us know.
Okay,
Let us
yeah,
know.
I know.
Let us know. I
I
want to
know.
know. Let's do it. Let's go. I'll meet you in the comments.
Everything's crashing all the time.
Feelings versus facts. Let's go.
You did see delinquency increase in some states here. On your screen, you're going to see Louisiana 5.6, Mississippi 5.5, New York 4%, Virginia 4%, Alabama 3.9, Maryland 3.7. And I think that's a factor for that's happening because of a lot of different reasons.
Yeah.
But in general, it looks like delinquencies are still okay. I'm going to say okay. It's not great because I think there's some other things that are going to happen to people. But serious delinquency, which is that 90 days or more, held. It held. It didn't even go up. It's held for 4 straight months.
Yeah.
So it's been consistent at that rate. And as you look at the days delinquent from 30 to 60 to 90 to 120, it actually starts tapering off, and eventually people end up getting in foreclosure. But this is actually a pleasant surprise in my week to see. I mean, to see this because there's a lot of chatter about NODs and foreclosures, but people who have a low payment that's on a fixed rate, I think that's not necessarily going to be the issue. I think it's going to be other stuff.
So I like what they noted here. They said, Still, as noted in recent CoreLogic, a strong job market is enabling most borrowers with mortgage to make payments on time, along with forbearance programs, and help struggling homeowners temporarily suspend or modify their payment structures. So I think that's a huge benefit as well, because there isn't there's so much safeguards in place now compared to years before that, even if you wanted to stop making your payment, you can call the bank. The bank's going to work with you. They're going to want to keep that asset flowing, because the last thing they want is to, get a whole bunch of houses and have to sell it at a loss. So they're like, how can we keep you happy? Keep making your payments. If we have to modify to keep you on track, that's okay. We'd rather do that than take a loss and then call it a day.
That's the lesson they learned back in the mortgage meltdown.
Thank you. I didn't want to say 07, 08,
but here's the thing. What COVID taught us a lot was, let's be a little more lenient with these modifications.
Right. Look how it played out. Look how it's playing now.
There was a moratorium where you couldn't make your payments for the first 6 months, and then they extended that for the next 6 months. So it was, and then they did it again for 2 years.
So what I liked about this is that if you look at this from 2020 to now, like compared to 07, when you basically took everybody's pads, everybody financially struggled for years, took them years to get back on their feet, to even be close to where they were at. Some people probably didn't even recover. Since 2020, exactly. So now when it happened somewhat similarly again, they took the right measures, and then look at how now foreclosures throughout the years are still being maintained at low levels, and they're not spiking like crazy like how they should have been if they would have just let people do what they got to do and not step in and make these these safeguards in place.
Correct.
So I remember many years ago when I started getting more in depth and more specific with the market data I started watching, there was a traditional transitional employment rate, unemployment rate like 3%, and I'm not like quoting the unemployment necessarily. I'm saying that there's always like 3% of the working population that's in transition. They've either lost a job, gained a job, or they've changed jobs. And so this 3% mark is really in line with this 30-day delinquency of 2.9%. I mean, they're almost like in lockstep. And some of that is to be expected, I think, because not necessarily because they're inextricably linked, but more that they're representative of what's happening in people's lives. It's a reflection of what's going on when someone's losing a job, a company's downsizing, someone passes away, or the breadwinner passes away, and the person that's in the house doesn't make money, or whatever it is. So there's going to be, there's a lot of variables that will cause someone to have delinquency. And I know that this traditional employment rate of 3% of people just kind of cycling in and out and through the system, that to me signals that it's okay right now, and there is no immediate threat. I don't think that long-term that is also going to be the case, because I think people are still under this heavy debt load. We talk about consumer debt being the highest it's ever been, crossing $1 trillion and still going. That's eventually going to have to be dealt with. And if home equity is also the highest it's ever been in recorded history, that seems like the most natural way out. I know it may not work for everybody, but that is going to be, I think, a way for people to avoid foreclosure.
And still
pay your debt down.
One thing I keep hearing, along the media outlets that I listen to is a black swan event, because they preface this exactly the same. They're like, hey, well, everything looks in line. There's no really much foreclosure information, but unless there's a black swan event, something that we can't foresee or happens, then this stuff could change. But if not, we're basically online to continue with the pace that we're at.
And I think a good sign moving forward is this chart here that talks about the transition rate. This is people that go from 30 days late to 60 and 60 days late to 90. And you look at the 30 to 60 days, and it went down from 22 to 23. Less people in that category. And then in the 60 to 90 day category, that's also less from November 22 to 23. So that indicates that it's actually tapering off. It's not always going to taper off altogether, but I'm just saying that of the data supplied, it is going in a neutral to better, not neutral to worse situation, which I think is good forecasting for looking forward for the rest of 2024 in mortgage rates. Provided some black swan event like you're commenting, I think we should expect this is going to be about the same. Year-over-year change in overall mortgage delinquency by all states and districts also is interesting, guys. There was 384 metros measured. 4 were in serious delinquency rate, where serious delinquency increased. There were 21 where serious delinquency stayed the same, and 359 where serious delinquency decreased. So 90% of the measured metros fall in this category where serious delinquency decreased.
Sheesh.
What do you think?
Oh, I mean, it's good. I can't say
Thank
much.
you for watching. No.
No, I mean, hey, we're talking about unemployment still. People
Yeah.
are just employed. The labor market is strong.
Yeah.
I mean, I think that's why we owe a lot to these numbers. It has a lot to do with this.
I think that's part of it. I mean, and I only say that not to correct. I'm just saying that there's part of the labor force that's just going to be renting, which is not necessarily a delinquent even factor or variable. It's really going to come down to people who can make those housing payments. And just because so many people refinanced in 2020, 21, and 22, I just think that we're going to see this because the types of things that are going to cause someone to fall into delinquency are going to be the lack of income or loss of income.
Correct.
It's going to be death of a spouse that either have two income and one person dies, or the only sole breadwinner dies. It's going to be divorce. It's going to be all sorts of other things.
That's what I was gonna say. I think it's gonna be a combination of different financial things happening at once. Not like them not being able to pay their payment because the payment's so low, but it's gonna be a combination of this, and that then leads to I can't do this now.
Right.
And it's gonna be gradually happening, and people are gonna be taking L's until I gotta sell this. I can't. I already maxed out my credit cards and
even if someone does fall into delinquency, I think selling
because
because
like you said, the house payment is the last to fall. So everything else is gonna fall before the big one does.
And here's the other thing. I mean, hey, right before I fail, I'm gonna sell it. I'm gonna sell it. I'm gonna probably have to move out of state,
and that's what people are holding on to.
I'm gonna probably have to go rent. So they have different outlets. And here's the other difference too of why I think we're seeing a lot of these numbers being so much lower than we anticipated before is because everything we've done for all the years since the SAFE Act was actually enacted, we've had to qualify everybody.
Yes.
There's no more stated. There is stated income and all that, but when you're doing the stated income, you're doing all that, you're putting so much more money down, right? So you're required to put anywhere from 20 to 40% down,
right?
Because the asset's the one that's really qualifying right there. And then what the bank is doing is like, well, okay, well, I'll let you borrow that money because now you put 40% down. And the likelihood of you not making that payment on that is a lot least likely.
It's very low. You're coughing up a ton of dough right up front, instant equity, if you will. And you're not going to get that back because you can knock on the door and go, can I have my money back? Nope. You're going to qualify for that bad boy.
We're 2007, 2008. You didn't need to be a veteran to buy at 100% financing.
Yeah. No,
you know what I mean?
That,
and what happened was these rates adjusted because we're all taking ARMs, an adjustable rate mortgage. And so when the time came and it adjusted from that 1% to 4 or 5% on $1 million, it was just...
It was catastrophic.
And I feel like people are closely watching their equity to the point where like, all right, if I sell, I won't be able to get out anymore. I got to sell now. Or I could still drown over here, resell, and make profit at the end. Until they feel like the pressure, then that's what
exactly.
And I see a lot of great value pertaining to this conversation in HomeBot. I know we provide HomeBot for all of our clients. They get a report every single month with their home value compared to their loan balance that's on record, as well as what the equity is doing up or down, what recent sales have been in your neighborhood, comparisons, that kind of thing. And that, if you are not receiving HomeBot from us and you're one of our clients, let us know, and we can make sure that you're that it's connected. It's always in there. But if for some reason you're not getting it, let us know. We'll help you figure that out. HomeBot is a great way for you to kind of track this, not because you're in delinquency, but you can see your equity. The delinquency conversation as part of the equity is going to be the way out for people who are in delinquency. That is the answer. If you are in a position where your house for some reason is worth less than what you owe and you're a delinquent, then those are signs of some other issues as stated in the article that are, conditionally because of finances or debt load and things like that. So,
and again, the HomeBot is knowledge is power, right?
Yeah.
And it's only when applied.
Yeah. Yeah.
So.
And that's what I like, that it gives you, the ability to learn how to leverage your asset.
Yeah.
Correct.
Yeah. Well, I'm really excited that delinquencies are going down. They stayed the same from year over year. That was very good to know. Not so surprised, but also a little bit surprised. I know that's playing both sides of the argument, guys. But that was satisfying. I'll put it that way. Satisfactory.
I think that leads right into my favorite thing of the podcast today. Yeah. I honestly really enjoyed that data that came out that from 2022 to 2023 foreclosure
building
was so low that it was unchanged.
Yeah.
So for me, data over emotions, always data over emotions. So that was really cool. And for all you crashers and the market's gonna crash, like let's debate.
Yeah.
Well, here's for me the great thing about it is I'm done. I'm ready to go brag.
Hey,
we got a homeowner here, huh?
Yeah, braggers.
No, brag. I honestly, I'm right there with you. You freaking sacrificed. You went through that process, and I don't know the backstory behind what it took for you to get there. And I think that's
and here's the thing. I like it because when I first bought my home, I remember thinking, I cannot make an $1,800 payment.
Yeah.
My purchase price was $242,000 at 8.75%. And Tanya and I were like, what the hell? How are we going to do this? And obviously we had our 3 kids. How are we going to do this? You know? And I'm serious. People laugh when I tell them, don't worry. You'll be able to do it. You just got to go to the dollar menu. I know there's no dollar menu, but I would stick around the Jack in the Box and McDonald's or the value menu, right? But that's what I tell, right? Or Top Ramen for a while, you know? And one way or another, it's like we got that. And then 2 years later, we bought our next one. Not even a year later, we bought the other one. And then 2 years later, we just started getting used to it because it became something natural that we understood what the process entailed, and they gave us the courage and you know, to allow us to go just do more. So that's what was cool about it.
Awesome. You conditioned yourself for the conditions.
Correct.
Yeah.
You know, it's like doing the first thing when they throw you in the pool, you don't know how to swim, and you're like, oh, worried. But after you kind of start going in there, it's like, okay, now I'm freaking swimming backwards.
Someone
here.
threw you in a pool and you didn't know how to swim?
I did not.
That's premeditated murder.
Yeah.
Best part of the show for me, guys, was the humble brag article. I actually really enjoyed talking about whether or not it is a humble brag or not, and whether you should or shouldn't say it. I am on the side of celebrate the win. You are buying the most expensive thing in your life, the largest monthly payment, your largest tax deduction in most cases, and you should celebrate that, especially because for so many people, it is treacherous to get in. And it's not that you can't, it's just that it's not easy.
Yeah.
The idea that it is just so easy to do, it takes work, it takes diligence, and you have to be committed to the process. And I think that is worth celebrating. And instead of being sorrowful or feeling like you're going to offend people about saying you're a homeowner, I think you should wear that as a badge of honor on your sleeve.
Yeah.
But if you are going to brag, make sure you build connection first and gradually build your way into the homeownership brag.
Yeah.
Hey, that's what the article said, okay? So
Yeah. No,
Well,
I like it.
I'm glad I don't have a dating profile. I don't want none of that trash. So sorry, guys.
And again, everything comes with the sacrifice, guys.
Hey, if you want to be a catfish, though, you could say multi-unit investor. Cap.
That's hilarious.
Hey, on another note, on a good note, 3 days ago, I finally, look, guys.
The cast is
gone.
on.
Thank you, everybody, for sending out your prayers to me. It's much better, but I still have to carry this heavy weight here on my left hand, on my left leg.
Congratulations. So. I did notice, Brian, the studio still smelled a lot better today.
Thank you.
Yeah.
Appreciate
that.
No,
it was the cast. It was his cast.
I showered today, so.
Well, then that's double. You stank. I'm glad you guys were
I thought you were throwing it at me. I'm like,
bone,
Friday.
right?
You know Friday, what, the 8th? Yeah, no.
Yeah.
Friday shower day for Brian. And,
big shout out to the nurses that when they take your cast off, they tolerate that.
Damn,
you know,
that's gross.
So,
follow me on how to save money on water bills. Don't take showers.
Well, thank you guys so much for another great show. Thank you
showers.
for being prepared. Thank you for all your input and your discussion, your opinions, and everyone that's watching. Thank you so much for following Mortgage Heroes. Be sure to like the video, subscribe to the channel, turn on notifications so you catch every episode as soon as it launches. And remember, if you have not checked out Friends of Mortgage Heroes, go find an episode in there about someone who you want to learn more about in and around real estate. Watch your episode, comment, engage, and if you want personal connection to them, you'll find their contact information in the description, or you reach one of these guys and we'll help you get connected.
Yes.
Thank you so much for watching, and we'll see you again next week.
Bye, guys.
See ya.